Welcome to this lease accounting tutorial for the FAR CPA exam. We'll break down key ASC 842 concepts with sample questions and step-by-step explanations. Let's dive in. Which of the following is not a part of lease payments? The correct answer is C. Variable lease payments not tied to a rate or index are not included in lease payments. Please be sure to remember the FAR mnemonic. This shows what lease payments include. Next question. Which of the following is a criterion for classifying a lease as a finance lease by a lessee? The correct answer is A. A lease is a finance lease if it covers a, quote, major part of the asset's remaining life. Use the owner mnemonic to remember all 5 criteria. If none of these apply, it's an operating lease. Next question. For a finance lease, the amount recorded initially by the lessee as a liability should normally. The correct answer is D. At the start of a finance lease, a lessee records both a right-of-use asset and a lease liability, each valued at the present value of the remaining lease payments. Next question. A company enters into a 3-year operating lease agreement effective January 1st, year 1. The amounts due at the end of each year are $25,000 in year 1, $30,000 in year 2, and $35,000 in year 3. The rate implicit in the lease is 10%. What amount, if any, is the related liability on the first day of year 2? Below is additional information showing the present values. The correct answer is C. There are 2 steps in solving this question. The initial lease liability is $73,816, calculated as the present value of all lease payments using a 10% discount rate. See Step 1 for detail. And at the start of year 2, the lease liability is $56,198, calculated by adding 10% interest to the initial balance of $73,816 and subtracting the year 1 payment of $25,000. See Step 2 for detail. Next question. Maine, a pharmaceutical company, leased office space from Ash. Maine took possession and began to use the building on July 1st, year 1. Rent was due the first day of each month. Monthly lease payments escalated over the 5-year period of the lease as follows. What amount would Maine show as deferred rent expense on December 31st, year 4? The correct answer is D. To determine deferred rent expense, we first calculate monthly straight-line rent as $20,025 by dividing total lease payments over 60 months. Next, we compute rent expense for 42 months, totaling $841,050. Then, we sum up actual rent paid by this period, which amounts to $769,500. Finally, we subtract actual rent paid from recognized expense, arriving at a deferred rent expense of $71,550. Next question. On December 31st, year 1, Rowe Company leased a machine from Colt for a 5-year period. Equal annual payments under the lease are $100,000 and are due on December 31st of each year. The first payment was made on December 31st, year 1, and the second payment was made on December 31st, year 2. The 5 lease payments are discounted at 10% over the lease term. The present value of lease payments at the inception of the lease and before the first annual payment was $417,000. The lease is appropriately accounted for as a finance lease by Rowe. In its December 31st, year 2 balance sheet, Rowe should report a lease liability of. The correct answer is D. To find the lease liability on December 31st, year 2, follow these 3 steps. 1. After the first payment, year 1, the balance reduces from $417,000 to $317,000. 2. Interest accrues, year 2, $31,700 is added to the $317,000, bringing the total to $348,700. 3. After the second payment, year 2, $100,000 is paid, reducing the principal by $68,300, leaving a final balance of $248,700. Thus, the lease liability on December 31st, year 2, is $248,700. Option D. Next question. Robbins, Inc. leased a machine from Ready Leasing Co. The lease qualifies as a finance lease and requires 10 annual payments of $10,000 beginning immediately. The lease specifies an interest rate of 12% and a purchase option of $10,000 at the end of the 10th year, even though the machine's estimated value on that date is $20,000. Robbins' incremental borrowing rate is 14%. What amount should Robbins record as lease liability at the beginning of the lease term? The correct answer is C. To determine lease liability, remember POETs. This qualifies as a finance lease due to the bargain purchase option. We calculate the lease liability in 3 steps. Present value of lease payments, $63,280, using the annuity due factor, 12%. Present value of purchase option, $3,220, using the single sum factor, 12%. Total lease liability, $66,500, sum of both values. Since we use the implicit rate of 12%, the correct answer is $66,500, option C. Always use the implicit rate if known instead of the incremental borrowing rate. Next question. Which of the following is true regarding lease payments? The correct answer is B. A residual value guarantee is a commitment to compensate the lessor if the asset's value at lease end is lower than expected. The lease liability includes only the difference between the guaranteed and expected residual value. Option A is incorrect because lease payments exclude variable payments not tied to an index or rate. Option C is incorrect because only the shortfall, guaranteed minus expected, is included, not the full guaranteed amount. And option D is incorrect because contingent rentals are not part of lease payments under ASC 842. Next question. On January 1st of the current year, Tel Company leased equipment from Swill Company under a 9-year lease. The equipment had a cost of $400,000 and an estimated useful life of 15 years. Semi-annual lease payments of $44,000 are due every January 1st and July 1st. The present value of lease payments at 12% was $505,000, which equals the sales price of the equipment. Using the straight-line method, what amount should Tel recognize as depreciation expense on the equipment in the current year? The correct answer is D. Since the present value of lease payments, $505,000, exceeds the asset's fair value, $400,000, the lease is classified as a finance lease under ASC 842. Since this is a finance lease, the right-of-use asset is depreciated over the 9-year lease term using straight-line depreciation. The calculation is simple. $505,000 divided by 9 equals $56,111. Thus, the depreciation expense for the year is $56,111. Next question. Neil Corp entered into a 9-year finance lease on a warehouse on December 31st, year 1. Lease payments of $50,000, which are due annually, beginning on December 31st, year 2, and every December 31st thereafter. Neil does not know the interest rate implicit in the lease. Neil's incremental borrowing rate is 9%. The rounded present value of an ordinary annuity for 9 years at 9% is 5.6. What amount should Neil report as finance lease liability at December 31st, year 1? The correct answer is A. At the lease inception, Neil records a right-of-use asset and a lease liability at the present value of future lease payments. Since Neil does not know the rate implicit in the lease, the incremental borrowing rate is used. Since the first lease payment is due 1 year later, we use the ordinary annuity formula to calculate the lease liability. Multiplying the annual payment of $50,000 by the present value factor of 5.6, we arrive at $280,000, which is recorded as the finance lease liability on December 31st, year 1. Next question. Retailer enters into a lease of warehouse space. The lease is for a 9-month non-cancelable term, can be extended for 4 months, and does not include a purchase option. On the lease commencement date, retailer concludes that it is not reasonably certain that it will renew the lease beyond the 9-month non-cancelable period because 1. The non-cancelable period coincides with the period in which retailer expects to need the additional storage, and 2. The monthly lease payments during the optional extension period are expected to be at market rates. How should the lessee recognize the lease? The correct answer is A. Since the lease term consists of a 9-month non-cancelable period and an optional 4-month extension, retailer evaluates whether it is reasonably certain to extend the lease. Given that 1. Retailer only needs storage for 9 months, and 2. The extension payments are expected to be at market rates, retailer concludes it is not reasonably certain to renew, making the lease term only 9 months. Under ASC 842, a lease with a term of 12 months or less qualifies for the short-term lease exemption. This means retailer Does not record an ROU asset or lease liability on the balance sheet. Recognizes lease payments as expense on a straight-line basis over the lease term. Next question. The present value of lease payments should be used by the lessee in determining the amount of a lease liability under a lease classified by the lessee as a CO. The correct answer is A. Under ASC 842, a lessee determines the lease liability for both finance and operating leases by using the present value of lease payments. Next question. On January 1st of the current year, Tree Company enters into a 5-year lease agreement for production equipment. The lease requires Tree to pay $12,500 per year in lease payments. At the end of the 5-year lease term, Tree can purchase the equipment for $30,000. The fair value of the equipment is $75,000. The estimated useful life of the equipment is 10 years. The present value of the lease payments is $50,000. The present value of the purchase option is $20,000. Tree's controller believes the purchase option price is sufficiently below the expected fair value of the equipment at the date the option becomes exercisable to reasonably assure its exercise. Tree would normally depreciate equipment of this type using the straight-line method. What amount is the carrying value of the asset related to this lease at December 31st of the current year? The correct answer is D. Tree Company classifies the lease as a finance lease because it has a purchase option that it is reasonably certain to exercise. First, the initial asset value is determined by adding the present value of lease payments, $50,000, to the present value of the purchase option, $20,000, resulting in a total of $70,000. Next, since the purchase option will be exercised, depreciation is based on the asset's 10-year useful life using the straight-line method, leading to annual depreciation of $7,000. Finally, after 1 year of depreciation, the carrying value of the asset at year-end is $63,000, which is the difference between $70,000 and $7,000. That wraps up today's lesson on lease accounting. I hope this breakdown made the concepts clearer and easier to apply. If you found this helpful, don't forget to like, subscribe,